So let's conclude our discussion about distributions to shareholders with some alternative thoughts, right? So the first theory or the model to think about is something called the residual distribution model. And up front, I'll tell you that I don't think this model is utilized in actual operations for any company that is publicly traded. It's probably really a tool that's used for those private corporations. But the residual distribution model basically says we need to figure out what are our internally generated capital, what are the retained earnings that we need for our capital budget. And anything different from that, we'll decide how that is paid out. So we find the reinvested earnings, that is the profit that we need for capital. We pay out any leftover earnings, that's the residual, as either dividends or stock repurchases. This policy is going to minimize flotation, that is the cost of issuing debt, etc. But it's also going to have some cost. It's going to have a signaling effect. So it may be able to minimize the weighted average cost of capital since it's going to maximize the amount of retained earnings that we use. Unfortunately, although not mentioned here, the challenge is it is going to make future dividends quite uncertain because they're going to depend on the residual. What changes every year? Well, net income changes, which means even if we have the same payout ratio, the dividend we actually pay out and the cash we pay out will be different. So that means retained earnings is going to be different, which now moves my internally generated capital. And if I need more equity than that, I'm now going to have to issue stock. So it's going to create some variance in how much dividends are actually paid each year, and shareholders would prefer some certainty. What this will allow us to do is get at least a little baseline of what might be a decent payout ratio, at least to start when we become public. So how it typically works is we take the net income of the company and we subtract out the equity we need from that. So we determine what our distribution is. Well, how much equity do we need? We take the target equity ratio, right? What is the relationship of debt to equity? And we multiply that by our capital budget. The capital budget is the money we want to spend next year. Some of that is going to be spent or gathered with equity. The first kind of equity we want to think about, though, is retained earnings, internal equity. So this will tell us what our distribution should be. So I think an example will make it maybe a little bit more clear. We have a capital budget of $112.5 million. Capital structure is 20% debt. We want to keep that. We think we're going to have forecasted net income of $140 million, and we have $100 million in shares. So let's see how this might play out with different levels of income. So let's take the first one down here, this first row. It says, look, we have 100 million shares, 80% is equity, 112.5 is the capital budget, 140 is net income. How much equity do we need to pay for this capital budget? Well, it's the weight, the weight. In this case, it was the 80% times 112. That means we need $90 million worth of equity. So how are we going to pay this out? We have net income of 140. We need 90 of that for the capital budget. That leaves us with 50 million. So now we have, in this case, a payout ratio of 35.7 or 50 cents per share dividend. But what if our earnings were only 90 million? In this case, 90 million is the net income. We still need 90 million for our equity gathering. You subtract those, that means there's no money for distributions. And of course, now dividends this year, in this instance, are going to be zero. If it was higher, of course, we would pay more dividends. So what this illustrates to us is that this residual model might give us a good starting point to try to see what dividends we ultimately could pay out based on our decisions of equity, our cash budget, and our estimated net income. But it also is not going to give us an exact number for us to pay. Again, the things that are going to drive the dividend in this case have to do with the investment opportunities, right? The more good investments we have, the more equity we're going to need. That means we're going to have to pay more. In this case, they went the opposite way. If you have few good investments, you're going to need less equity to pay for them, so you'll be able to pay a higher dividend. Again, the variability of income, the variability of upcoming opportunities is going to have an impact on the payout. And again, one of the critical things I think that we all understand is that shareholders want certainty. This is not a very certain methodology. So the advantages, it's going to minimize the new stock issues that we may have to be and the cost of issuing stock. The disadvantages, as I've mentioned, results in variable dividends, might be some conflicting signals, risk could be affected, and again, investors in general are not going to be happy with this uncertainty. So again, this might be a place to start, as it says here, but we don't want to follow it. So let's talk about the procedures of a dividend. So we kind of understand how the mechanism works here. So what's going to happen? There's a declaration, right? On November 21st, we got this announcement. We're going to declare a quarterly dividend of 50 cents to everybody that's on a record holder or is a owner on December 20th, and it's going to be paid on January 10th. So what happens, imagine there's a book that has everybody's name in that's a shareholder. On December 20th, they look at all those names. Anybody that's in that book will get a dividend. The challenge, though, is it takes time for names to get into the book. So what if you bought the stock on December 18th? Your name may not be in the book yet, but yet you are a legitimate titled owner. So what we have is something called the dividend X date or the X dividend date. That's typically 2 to 3 days before the date of record. So on December 17th, this dividend goes with the stock, and the owner on that day is going to get the dividend. But the very next day, at the end of that day, that's what's referred to as the ex-dividend date. On this date, if you bought the stock this date, your name is not going to make it into the book, and you won't get the dividend. So you're an owner, but you don't get the dividend. So what happens? On this ex-dividend date, we're going to see that the stock price will fall by the value of the dividend. So if it's a 20-cent dividend, the value of your stock on December 18th, when you sell it, is 20 cents less than what it was yesterday. So now that other person that you just gave the price at 20 cents left, they get the lower price plus they get the dividend, so they get the market value of the stock. Then, of course, on January 10th, the dividend is actually paid. Let's talk about stock repurchases, right? This is where the company buys back stock. Why would they want to do that? There's lots of reasons for it. They may not want to pay out dividends in the form of cash. Well, why might they not want to do that? Well, companies or investors are going to expect dividends to have certainty. If you increase the dividend, shareholders are going to expect that increase into the future. Maybe you just have one-time cash after you sell a part of the business. Maybe you want to just make a large capital structure change for some reason. And we also could use these repurchase stocks for employee stock options when the employees exercise those options. So what is the process of that? We announce the repurchase, and of course we have to figure out how we're going to do this. We could have a broker just go out and buy the stock from the market. We could make a tender offer to shareholders, basically say, hey, we want to buy this stock back. Maybe we'll give them 20 cents more than the market value to get them to sell us back their stock. Or there could just be a block out there that we want to it's called a targeted repurchase. And I've got to tell you, I'm not sure the exact process or procedure of identifying the block. But ultimately, we just need to find these shares. Now, the company doesn't have to complete its announced intent to repurchase, right? I have an intent to repurchase, but that doesn't mean that I necessarily have to repurchase or that I have to repurchase the amount that I say. So let's think about a company and distributions, right? So this company has a value of $19.37. They have $50 in short-term investments. There's their debt, $387. And they have 100 shares. What happens if they pay a dividend of $50 million? Well, before the dividend, here we see what we just talked about. The stock price is roughly going to be about $16, right? The value of the company is $1,600 divided by 100. $16 is the value or the price of the stock. Now, after the dividend, we're going to use the short-term investment to pay the dividend. Again, we're out here, 1937 is the value of the stock. Subtract out the total debt. Now it's 37,850 or 387.50. We now have less equity. Divide that by 100. That means the stock is now worth $15.50, but the dividend was worth 50 cents a share. So again, you see it's still $16. Part of it, though, now is the dividend. One of the things that we'll show in a second here is that as a repurchase has no effect on the stock. Now, that doesn't mean that a repurchase won't affect stock price. The announcement itself may be a signal that affects stock price change, but the journalizing entries will not create a change in price for the stock. So again, the actual repurchase itself has no impact. It's the information that may have that. So if investors thought that it was a good idea, that it would increase stock price, they'd all go out and buy the stock the day before, and of course that would drive the price up. So again, it's the information that's given that changes the price, not the actual distribution itself. So we need to figure out how many shares are we going to buy back. So the post-repurchase number of shares is whatever you had before minus the cash repo. How much are you going to buy back divided by the number of the price? In this example, you can see here we're going to buy back, or we're going to end up with 96.87 million shares. We're going to buy back 3.125 million shares. So what does this look like for the company? Again, the 50 million is where we're going to get the cash to buy this. 1937. Again, what is this? 1937. Now the shares of stock are what? 1550 still, because we used $50 to buy back this stock. But in this case, now the shares changed. Now we only have 96.875 shares, which means the stock price itself doesn't change. So what are the key points about a stock repurchase? We're going to use some kind of short-term investment or cash to buy this back. So obviously that's going to decrease. The stock price itself is going to be unchanged. And in this case, the equity went from 16 to 1550, but now there's fewer shares, so that equates out to no change of stock price because of the actual distribution. Now, the wealth of the shareholder stays at $1,600 because they got $50 million from this transaction. So they've got the $1,550 in value of the stock. Some of those shareholders now have $50 million, so their wealth did not change. So what's the difference between repurchases and dividends? In a repurchase, stock price doesn't fall at the time of the repurchase. The number of shares falls. For a dividend distribution, the stock price falls by the amount of dividend at the time of the payment, but the shares don't change. So what are the advantages of repurchases? Now, the red stuff here are my thoughts and what I think with the current tax code, what this actually means. But if you're a stockholder, you can choose to sell or not sell. So you can decide not to trade your shares in. This repurchase of share could avoid setting a higher dividend that, again, you can't maintain. Now, they talk about the tax impact. Well, both capital gains and dividends are currently taxed at the same rate, so there's really no difference here between capital gains and dividends with respect to taxes. However, you now no longer own the stock, right? So you've now become a non-owner of the company, and you will not get future growth, obviously, because you're not an owner. Stockholders could take a repurchase as a positive signal, right? Management could think that this stock is undervalued, and that is why they're buying it back. If that is their thought, then of course that could have a positive impact on the stock price. What are the disadvantages? Well, investors could think it's a negative signal, right? Why are we doing this? Why are they spending this cash? They're not giving me a dividend. Why repurchase stock? Well, if the company has nothing else to do with the money, it's just going to sit there. What do they do with it? They've already bought all the things they want to buy. They could just have poor investment opportunities, which implies that future growth is going to slow. And of course, they mentioned that the IRS could impose penalties if repurchases were primarily to avoid taxes on dividends. Well, again, I think this comes from several years back, around 2005, when dividends were taxed substantially more than capital gains. But now, in today's world, they're taxed the same. So I can't imagine why we would imply there's an advantage to not paying taxes when they're both taxed at the same rate. One other thought to think about with respect to dividends is something that's referred to as stock dividends and stock splits. A stock dividend is when a firm issues new shares instead of paying a cash dividend, right? The investor gets nothing other than more shares. So you get 10%. If it's 10%, you get 10 shares for every 100 shares you own. A stock split is just a bigger stock dividend. In this case, it could be 2-for-1. So each shareholder gets more shares, but in this case, it's a 2-to-1 relationship. So if you had 100 shares, you would get another 100 shares. You'd end up with 200 shares for every 100 shares you owned before. Why do companies do these splits? Well, if you think about what happens, all the company has done is take the equity pie, if you will, and has divided it into smaller pieces. So if you have an apple pie and you cut it exactly in half, and if you owned half of that pie and I earned the other half of that pie, what would happen if I cut my half in half? So now I have two pieces, but my two pieces are exactly equal to your one piece. So when a company splits its stock, it divides the pie into smaller pieces, but the owner's control doesn't change. So what does change? The number of shares changes. Control doesn't change. The only thing that changes is the price of the stock. So again, unless there's some kind of information that's provided or something else that they mentioned here, what if they decide to keep the dividend the same and now give you twice as many shares? Well, now your cash flow's doubled. Not just doubled, but it has actually quadrupled because you were going to get half the number of, you were going to get twice the shares and half the dividend, so you got the same value, but now you have twice the shares and you have double the dividend that you should have gotten, so now you'd have twice the cash flow. So why do companies do this? Primarily, they do that for what we refer to as an optimal price range. Research has shown us that companies tend to provide the greatest amount of information. Most of the trading activity happens to stocks that are in the $20 to $80 range. Now, this study is pretty old that talked about this, so we might apply a little bit of inflation here. So we might now say that it's kind of like, 50 to 100 is where all the action is. But in general, saying, look, companies want people to know about them. They want them to analyze them. They want them to think that they're a good company. If we keep it in a place where people can buy it, people will pay attention to it. Don't know if you're familiar with the company Berkshire Hathaway. It's kind of run by Warren Buffett. Right now, it's roughly selling for about $300 some odd thousand a share. Well, how many shares can the average person buy? Would an average person even look at that stock if you had no ability to purchase? So again, the idea here is we cannot necessarily manipulate our stock, but from time to time we can put it in a range where people pay a little bit more attention to it. So again, that's the end of our video on dividends. I look forward to seeing you the next time.